We're actually starting the class with. Let me know if you can not no longer see my screen, please. Did you get that? All right.
Yes, sir. You can see the screen.
All right. So basically, I treated types of market orders the other time, and I was more like it should be more practical because we are making use of MetaTrader 4 and MetaTrader 5, and with that, we are more like executing a trade. That is the part whereby we start executing a trade perfectly ourselves without any issue, or let me use the word disbeliefs and everything. Do you get that? So now types of market order basically is just an order you give to the market either to probably kick you in for a buy or a sell. So if you are buying, then there are two types. Is either you there are two or three types, right? If I'm not wrong, is either you make use of an instant market execution, or you make use of a buy or of a limit order, or you make use of a stop order. Now let me give state the three difference between the three. Between the three is number one, the instant market execution means the point at which the market is currently, at which the price it is currently, is when you probably click for a buy or a sell. What a limit order means, you are expecting market to reach a particular point, a particular price lower than what? Lower than the current price. So where you buy from. Why a stop order means you are expecting market to trade to a particular price higher than what? The current market price, whereby you do what? You buy from. That's just it. And if you are selling, the same goes for also for selling as well. So basically, let's move straight to the next thing. And the next on the line right now is I have introduction to what market orders. And as I've said, it is actually what an instruction you give to the market, right? Which allows you to do what? Which executes a trade for you immediately at the current market price. Do you understand? So moving straight to the next on the line, I have what? Again, I have the first phase of market execution, which is what? Instant market execution. And what does instant market execution do? It's actually an order that executes trades, right? Immediately at current market price. I've explained that initially. So make sure you find yourself, you make use of the materials being dropped, and you also have access to the videos on YouTube as soon as possible. Do you get that? So basically, next on the line is what? Now I have this, and what this does is if you first open what your MetaTrader 4 or MetaTrader 5, this is the first interface you see. The first picture by my right here is the very first interface you have access to. And what do you see there is you see the likes of quotes, charts, trade, history, and settings, right? So if you probably now click on the quotes, you have access to this first line, this first phase, right? And after, then you click on any currency pair of your choice. Probably you have interest in buying GBP USD or selling GBP USD. Then you tap what? You tap GBP USD. It brings you this second picture. This picture on the second phase here, right? Whereby it brings trade charts and details. Once, and mind you, you have in mind that you want to trade, right? So you click on the trade. If you click on the chart, it will display something more like the chart interface for you. But no, you are clicking on trade. What is it now going to display for you is now. Be so sure. The very first thing you should notice is at the top here, at the middle, you must see the pair in which you want to trade. Had it been I want to buy GBP USD, and at the top here, I'm seeing maybe AUD USD. Then that means I've already picked the wrong currency pair, right? So I will have to probably go back to have access to that. Are you following me?
Yes, sir.
All right. So immediately after that, what happened? GPUSD, it is correct. Now you can see the next thing is market execution. Had it been market is already at my entry point and I probably want to buy or sell, then I make use of market execution. Then what I'll just do is I input my stop loss and I'll put my take profit. Our next topic is what? Risk management and the like. So you will understand the concept of stop loss and take profits perfectly. Do you understand that? So let's say for market execution, I want to buy GPP USD at current market price. So I just click on buy. immediately. And as you can see, this 1.0 means what? Lot size. That's what we refer to as what? Position sizing. And position sizing is what? It's actually what determines the amount of money we make or the amount of money we lose when it comes to trading in general. Right. So the difference between myself using 1.0 lot size and someone else using zero point 0.1 lot size is number one, we are all students. Number one, we are all students, right? Well, number two, we are all traders. Sorry, we are all traders, number one. But number two, we should find ourselves that what now distinguishes both of us is the fact that we are making more money compared to each other. For example, I'll be making more. I'll be making more money compared to someone using using 0.1 lot size. If I'll be using 0.1, if I'm using 1.0 lot size and someone is using 0.1, I'll be making more like times 10 or whatsoever the person is making, right? So we are both traders, but we are not making the same amount of money. Do you get that? So we still get there too. You understand? So let's now assume the price is currently not at your entry point, and you have in mind that probably you're having an exam or you're going somewhere very important, and you don't want to miss that trade. There are two things you do. If you intend entering the market at a price lower than the current market price, then you go for a buy limit. That is, you want to buy the market at a price that is lower than the current market price, then you enter for a limit order. That is, buy limit or what? Sell limit. But sell limit is when you intend buying at a price higher than the current market price. I don't know if you are getting it right.
Please come again, sir.
All right. If you intend buying at the price higher than the current market price, then what I'm expecting you to go for, it is what? You intend buying at a price lower than the current market price. That is, price that is below the current market price. You go for a buy limit. But if you intend selling at a price higher than the current market price, you go for a sell limit. Do we get that?
Yes, sir. Yes, sir.
Someone wants to join? As I've said, if you intend buying at a price lower than the current market price, this thing is logical and practical. Do you get that? You intend buying at a price that is lower than the current market price. You go for a limit order. But limit order will be what? Buy limits. But if you intend buying at a price higher than the current market price, you go for a what? Limit order, which is what? Sell limit. You intend selling at a price higher than the current market price, then you go for a what? Sell limit order. So take note of this. This is the trick you should use for you not to get it twisted. Number one, you want to enter the market at a price that is lower than the current market price. Then obviously you should not be expecting a sell. Do you understand that? For example, the current market is what? 5 naira. And you want to enter at a price of 3 naira. And you're expecting it to pass, you're expecting the market after that 3 naira to pass the current market price, which is 5 naira. That means you want to buy, right? So, which means once you are, what you are doing as around that period, around that time is what? You should consider a what? Limit order. And the limit order in this case should be what? A buy limit. Well, if the current market price is 5 naira and you intend on buying around 6 naira, but you are expecting the price to now pass that 6 naira, then you should go for a limit order. But in this case, it should be what? A sell limit order. I think it's now reasonable enough. Now check my charts. Check my chart here and see a pictorial diagram. If Where's my, all right. Let's say this. This is the 4 hours time frame for a particular chart. Now, I did mean I want to enter the market at this current price. Then what I'm going to do is I click on buy or sell, depending on the choice I want to make based on what I'm seeing on the chart. But let's now assume I want to enter for a buy at a price that is what? Let me go on lower time frame so you see it very well. Let me delete this. Now, let's say I want to buy at a price that is lower. You know, the market is currently around this point, but I want to buy at a price that is lower than the current market price. Here, what I'm expected to do is I'm expecting the market to trade down a little bit. I'm expecting the market to trade down a little bit. Give me something like this. Tap into my entry point, then go higher. That's for a buy limit order. Do you understand that? Do we get it now? Hello, please. Am I speaking with someone?
Yes, sir.
All right, that's very nice. Perfect. So this is that about is it, complete it for me. Now, this is the concept of what? A buy limit order. But for a sell limit order, you have a price, your price is currently here, and you want to enter for a sell, but you are not sure. So you are now like, okay, fine. If the price can reach somewhere around there, then you should be going for a sell. Then what will happen henceforth? Before that point, you will put your sell limit somewhere around there. Then your stop loss must be above your entry point for a sell, while your take profit will be below your entry point for a sell. So the moment the market finds its way to this point, what will happen? The market will kick you. Your broker is definitely going to kick you in for a what? For a sell. So if the market is not going in your favor, then you are lucky enough, you make money. But if the reverse is the case, then you probably, you know, you get that. You get what I'm saying now? So that's that about that. Do you have any question for me? Hello?
Sorry, I listen.
All right. Do you understand that now?
Yes, sir.
All right. That's very much beautiful and all. So there's one thing I want you to do for me right now. Immediately after this class, let's say latest, maybe around in the evening, find your way to on the charts. Yeah, do a limit order for both buy, sell, a stop order for both the buy and the sell, and also make use of instant market execution. Is that what you can do for me? Hello? Is that what you can do for me, everyone?
I'll try to do that, sir.
All right. Not even try. I want you to do it for me. Do you get that?
Okay, sir.
Yes, sir.
Yeah, all right. I've given I've given the simplest explanation for limit order, both for the buy and the sell. Let me know if you have a question. Do we? All right. Since we are not talking, that translates to the fact that maybe we get everything right. Abi, am I right? So next on the list is what? Stop order. I'm just recapping the last class before we move straight to today's class because there's no point in you not getting the last class and we moving to another topic. Do you get that? So now stop order. The difference between a buy stop and a sell stop is very simple. They're almost the same thing, but just the reverse of each other. For example, a buy stop is you are aiming to buy at a price higher than the current market price. Market is currently at 5 naira, but you want to buy at 8 naira. So, and you are not expecting the market to come lower than that 8 naira once the market reaches that 8 naira point. Do you get that? If at all it's going to leave that 8 naira, it should not pass the 5 naira point. Remember, we are dealing with dollars, but I'm using naira to explain so that you can get and understand everything perfectly. I don't know. Can we all see my screen? Okay.
Yes, sir.
So, all right. So for the sell stop, it is what you are planning to sell at a price that is what lower compared to what? Is it lower? Yeah. For example, you are trying to sell at a price that is below what the current market price. Let me use that word so I should not confuse everyone. For example, my sell stop would definitely must definitely be below my current market price. That is, the market is currently around here, but I'm expecting if I can see markets trading below this point, then I don't think the market should come up again. Then I can put a sell stop here. Then my stop loss must be above that. Then my take profit will be what? Price below that entry point for a sell stop. But for a buy stop, I'm trying to buy at a price that is higher than what the current market price. Once this price finds itself around this entry point, what will happen? I'm expecting it to continue moving higher. Do you get that? I'm not expecting it to come lower again. That's just me for you. So that's that about that. And I feel let me know if you have questions before I move straight to the next thing. Just make sure you read and digest the PDF very well. The file sent to the group, digest it very well, and ask me any question. And also do your research. Do some little research. Go on YouTube, make use of any platform you want, just for you to do what? To understand basically the real concept behind the limit order and the stop order, and also the instant market execution. Come to my DM if you have any question. And also make sure you stick to the assignment, and the assignment is you making use of an instant market execution order, a limit order, and a stop order to do what? To execute a trade and send to me. Please, I'll be expecting that in my DM. Do you get that? So, next on the list is, am I record? Okay. Next on this is, I want to move to the next topic. Remember, this is just still an introductory phase. Part of it is we've learned how to enter a trade, right? We've learned the basic terminologies. We've learned the rudiment of everything. So now, considering all things being equal, we are expecting ourselves to now go deeper. And deeper in what sense? We understanding what risk management, what it is that we do on the market itself, and what risk management truly entails. Do you understand that? So now the topic is what? Risk management in the FX markets. Protecting your capital and growing sustainably. That is the goal of every trader on the market is you're coming to make money. But at the same time, this is a game and this is an avenue where it is very possible and it's likely for we to lose money in the process of gaining money. But what now makes you a very good trader is you making more than you are losing. That is, you are, if at all, my overall losses in a month is $100,000, then that means I should be expecting, I'm expected as a very good trader to make more, way more compared to 100K. As simple as ABC. So the concept of risk management also does what is applicable to what we can easily pinpoint in which aspects again and in which areas of life. In let me use the word in our day-to-day activities. For example, as an OAU student, you are going on campus, you are selling, for example, maybe you are selling cake, for example, and one cake is going for 1,000 naira. So the goal is after your transport, after everything, you should be coming back home with something higher than 1,000 naira. That's what makes you a very good entrepreneur and a very good trader. Yes or yes? Yes. Do you understand that? So likewise on the forex markets, you are entering the market with the aim of making money. But remember, trading is a game of probability. You are liable to lose in the process of trying to make money. But what makes you a very good trader is what? The fact that you consider your profits should be way more, if not way more, but at least should be more compared to your loss. But in a scenario whereby you are not making more compared to your losses, then you should probably be making equivalent of your losses in profits. So that makes you to be at equilibrium. Do you understand that?
Yes, sir.
Yes, sir.
All right. Moving straight to the point. Moving straight to the point. Risk management in the FX markets, in forex trading, protecting your capital and growing sustainably. Remember the word sustainably. That is, you are growing. Rome was not built in a day. You are not trying to make everything at once. You are actually looking for a way to grow your investments. You are looking for a way to grow your money. So you have to do what? Make use of a very good risk management. That is if you are entering the market with $10, your aim is to make more than that $10. If you are not making more than that $10, then that means you are not a good trader yet. You are still probably struggling as a trader. Do you get that? So next on the list, introduction to risk management. Now, why risk management itself? Why? Number one, risk management is what? The foundation of successful trading. It is not just winning trades, but protecting your capital. That is, what happens when you are not making money? I'm not promising you are going to make money on the market all the time. No, I'm not. And I will never promise that because no trader, anybody promising you that they're after your money, they're probably just giving you the gist part of trading. So you get to enter the other aspect of trading yourself. But as a good trader, you just have to make sure your risk management is intact. You ensure your risk management is intact. And what? Managing risk helps you to avoid larger losses and maintain consistency in your trading journey. This is the main reason behind what? Risk management for you. Do you understand that? Now, from our previous stuff, we are talking about risk management when we are making mention of stop order and the take profit order. The stop order is what? Is an order and is, let me use the word, It is that you give to the market to take you out of a trade. That is to close the trade for you when price hits a certain point, and you are not expecting it to go more than that if the market is willing to go in your favor. Take note of this. It is very important for you to make use of stop orders on every of your trades. Do you understand that? So please, if you are entering your market, a market, either a limit order or an instant market execution, the first thing you should take note of as a very good trader is number one, it must have a stop loss point. That is, this is the point that I am willing to get out of the trade if the market is going against me. And if the market is going in my favor, this is the point in which I'm willing to go to leave the market if at all it is even going in my favor. Do you understand that? What is take profit region? It is a way to lock in profit by automatically closing a trade when a certain price is reached. Now, what take profit does to you in your trading journey is what? It avoids what? It helps you avoid what? Emotional trading itself. Emotional trading in what sense? Will the market reach this point? Okay, what if I leave it to this point? But the moment you are expecting the market to reach this point and it reaches there, your broker will take you out to avoid probably, it's very possible for the market to reach a particular point, your take profit region, and reverses on you. Once it reverses itself on you, what now happens is where take profit is now very important is you're out of the market already. So what happens next after the market, either profit or loss, is none of your business. So what you just have to do is take your profits and enjoy yourself. Do you get that? Now, understanding leverage and margin. As I've said earlier, I've explained leverage and margin, but we have to talk about it again under the concept of risk management. But leverage and margin is leverage is what? A certain amount of money your broker gives to you that gives you access to trade more than what you have as your trading capital itself. That is what leverage does for you is what? It allows you to increase your position. That is, you have for example, $50 capital. Leverage will give you assets. Maybe let's say 10 leverage will give you access to use the same position as someone having an initial capital of $500. Now, margin. Margin is what? The amount of money needed to open a particular leverage. Do you get that? For example, if I want to open a 10.0 lot size with $10 account, I must be having a leverage of maybe, let's say, 1 to 100. That's the margin required. So the margin required right now is I must have, for example, the enough money in my capital, in my balance to execute a particular trade. So now, take note of this. Higher leverage increases both what? Potential profits and potential losses. So the higher your leverage, yeah, the higher you are liable to do what? To lose when it comes to the market. And the higher you're also liable to do what? To make money when it comes to trading as well. When it comes to profit aspects of it. Okay, simple as ABC. Now, how do you calculate position size? Position size is what? The number of units of a currency pair that you trade. That is the number of units of a particular pair. For example, if I'm opening 100 lots, that is my position on GBP USD as at that current period of time. While someone else's position might be probably 10, while someone might be 5, someone else's might be 0.1, someone else's might be 0.01, depending on what is chasing both of us and depending on what we are aiming at as a trader. If you are aiming to buy a Lamborghini, then using 0.01 makes you a joker. Do you get that? So the formula for you to calculate position size is what? Your account size, which is, for example, $100, divided by what? your stop loss, which is maybe, for example, 20 pips, right? That will give you the number, the amount of what? The amount of positions, the amount of lot size you have to use. If, for example, I'm operating a 10 and $100,000 account, right? I'm expecting to use maybe 20.0 lot size. So I'm expecting to use maybe 20 pips, right? So that means I should be risking around $5,000 on that trade because I'll be doing $100,000 divided by 20. That's $5,000. Do you get that?
Calculation,
That's
sir, please, sir, please.
what do you
The
say?
calculation, help us like.
The what?
I said you should put like recap calculation aspects.
All right. Let me try and come again. Though we have a website that does that for us as a trader, but I don't want us to be lazy. I want to give us the manual aspect first before we go into the rest. Do you guys get that? So for the calculation aspects, just know it, but it's not necessary you cram it or you probably have it, Just know it. For you to calculate the position size, that is the lot size you want to try and use. Do you get that? Take my example here. If risking 2% of $1,000 account with a 50 pip stop loss, the position size will be what? Now, 2 times $1,000, right? Over what? 50 pips. That should be, you are risking $40. Do you get that? So you make use of a stop loss that will give you around $40 loss. That should be like around 0.2, 0.3. But now let's go online and make use of the electronic aspects. Come here, you type www dot, do you get that? Babypips.com. Go. Do you get that? It's loading. It's loading at the moment. This is what we have here. This is the easiest way for you to calculate your thing. You don't have to stress yourself too much. I just want you to know. I just want you guys to pass through the manual parts, the manual aspects. But www.babypips.com.
Sir, we didn't get that though.
Now, if you want to calculate the number of the lot size you have to use without guessing, do you guys get that? All you have to do is you check online, you put www. Or you just write babypips.com. The link is inside the PDF already. I'll be dropping the PDF immediately after the class. But for us to be on the safer side, www.babypips.com/choose/position size calculator. What this does is it gives you the proper and the standard lot size to use based on number one, the current market condition, number two, the current spread, and And also putting into consideration the amount of what's it called? The type of what's it called? What's it called? What's it called? What's it called? The type of currency pair you are trading. For example, if I want to trade GBP USD and my account size is $1,000, right? $1,000, and I want to risk, let's say, 1% of my accounts, right? And my stop loss is, let's say, 20 pips. I want to trade Euro GBP USD, for example. Then I'll come here. I click automatically. We usually have it somewhere around the Euro USD. But yeah, maybe GBP USD is where I want to trade. Then I click on GBP USD. Make sure you enter everything correctly. Your account balance is $1,000. You are trying to risk 1% of your account. That is around 1% should be around $10, right? Am I right?
Yes, sir.
Yes, sir.
All right. Then after you click on what? Calculate. Once you click on calculate, it's now recommending to you that the standard lot size you are to use if you know you want to risk $10 on this trade is 0.05. But if you want to risk, let's say $100, use 0.5. Now, if you want to risk the whole $500 or the whole $1,000, then risk what? Then use 5.0 lot size. So you go on your MetaTrader 4, your MetaTrader 5. If you make use of this lot size as specified by the market itself, by this baby pips itself, position size calculator, you are not going to lose more than what it wrote here. It wrote amount at risk. If at all you are losing, then that means you did not account for the spread before you input what? The number of pips for the stop loss. Do we get that?
Yes, sir. Yes, sir. It's,
All right. Thank you so much. Thank you, thank you, thank you, thank you, thank you. So next on the list, this is the website here. I have it inside the PDF already. Go through the PDF again and read accordingly. Next on the line, I have what? The importance of risk to reward ratio itself. Who is that trying to join? All right. I thought someone was trying to join. All right. The importance of risk to reward ratio. Risk to reward in risk management, right, means the amount you are risking compared to the amount you are gaining. So the standard risk to reward, that is the least you can ever have, is either you have 1 to 1 risk to reward or 1 to 2 risk to reward. That is, if you are risking 1% of your accounts, then make sure you make at least 1% back. That means if you are risking $100 on a particular trade, your aim should be at least $100 back. So in total, you are making what? You are expected to make around $200 in return. Do you get that? So what that is expected to do for you is if I'm risking certain percentage or certain amounts, then I should be making such amounts back in return, if not more. But a common and a standard that is the most meaningful one is at least 1 to 2 days to reward. That is, if I'm risking $100, my potential profit in return should be around $200. And what should that be mean to me is in return, if I'm risking $100, I should be making $300 in return. If I should remove my $100, I should be having $200 in return. For example, if you are risking 100 naira, your potential profit should be around 300 naira. So that way, when you remove your 100 naira, then you'll be having 200 naira in return. So that is what we actually refer to as what? The trade is worth risking. If you are checking a particular trade and it's not giving you at least 1 to 2 risk to reward, the trade is not really worth it. As you can see here, I have this, right? And my risk to reward is what? 3.0. That is, I'm risking 30 pips to make around 90 pips. Then to some extent, the trade is what? Worth risking, worth taking. Perfectly, everything is perfect. Someone wants to join, okay? Do you get that? Should I move on? Or there is an aspect you want me to enter? Sorry, that place is noisy, please.
Yeah, how do we calculate this stop loss pip?
All right. You come on your trading view here or your MetaTrader. If you have the mind of buying, all right, let me pick another pair. Let's say GBP USD. You want to buy GBP USD. Then you come here, you click the long position and you put it here. This is the mechanized one. Your TP should be above your entry point, while your stop loss should be what? Below your entry point for a buy order. So now, can you see here, written here? If you can see my screen very well, it is written here 21.1. That is my pips, my stop loss in pips. So it means I'm risking 21.1 pips on this trade to gain 52.8 pips in return. So as a normal trader, is that reasonable enough or not? Yes, it is. Do you get that now? So next on the line, if we are getting that is what? Okay, we've talked about the importance of risk to reward ratio. Now, key takeaways. Notes. Remember, I was actually not rushing anything. So rather, I was making it look simple and also a step at a time. We don't have to rush it. I know trading might look complicated, but trust me, we've not even entered into the real deal of trading. We are just equipping ourselves down. So take note of this. Key takeaways. Always use stop loss and take profit orders. Take note of that. It is very important. Always, if you want to be a very good trader, make sure you always make use of what? Stop loss and a take profit order. And also, make sure you are understanding leverage and margin very well before you enter a particular trade. Not that you have maybe $100 accounts and your leverage you are picking 1 to 10 and you are trying to probably use 5.0 the time. It does not work like that. You have to pick the right leverage while opening your account. Put it to unlimited or maybe max of 1 to 2,000. Do you understand that? So immediately after that, calculate your position size based on your account balance. So, which means the lot size you are to use based on your account balance will definitely be different from someone operating an account balance higher than yours. For example, I'm operating a $500 account. The stop loss I'll be using will definitely be different from someone operating a $5,000 account, except if I'm using a very high leverage and my account is at higher and greater risk. With that, now next on the list, always aim for a positive risk to reward ratio to maintain a profitability. To maintain what? Profitability. Your risk to reward must be positive. That is at least 1 to 2. And you must be consistent with it. Rome was not built in a day. Consistent efforts, right, brought about Rome being built afterwards. Do you get that? So now, last on the list, consistency over profits. What does that mean is make sure you focus squarely on consistency and your proper risk management because that is the only way you can make a good fortune out of trading itself. Now, losses, take note of this. Losses are part of the process, losses are part of the game, but managing them ensures a long term success. You see people buying Lamborghini, people buying a very expensive gadget and the likes. What does that mean? It actually means and implies that does not mean they are not losing, but it means they are making use of a proper risk management that converts and that is giving them a very good hedge. And in the long run, they are making more than they are losing. Simple as ABC. Now, let me now leave you guys with these quotes. Your first goal is to protect your capital while the profits will follow after. Take note of that. Capital safety comes first. The moment you are able to secure a very good capital for yourself, that is, you started with the week with $100, you are currently on $150, then you are now safe to now trade anyhow and ensuring you are not risking more than $50 so as to have your capital safety intact. So thank you so much. Thank you very much for attending the class. Do you have any question? I'll be
Thank you,
releasing the
sir.
recording. I'll be releasing the recording very soon, in like 2 hours time max, because I will have to edit and everything. So immediately after that, I'll be releasing the recording. So if you are finding some aspects kind of difficult, just go on YouTube, probably latest around 3. I'll have it recorded today. Certainly, I will edit it today. Do you get that? I will edit it today and I'll have it posted on YouTube as well. So everybody will definitely have access to it and we all smile. And releasing I'll be releasing the PDF too on the group very soon. Not even very soon, immediately after
Okay,
the
sir.
class. So do you have any question for me? Do you have any question for me, guys?
Probably when we go through it
All right,
again, we can.
that's fine. In the meantime, I wish you guys successful and happy trading. Study very hard and make sure the goal, your forex trading goal, you don't forget the reason why you start trading. Do you get that? So please make yourself available and the sky is what our starting point. Do you understand? It's not even our limit, starting point. And we are
Thank
going to
you.
excel and succeed eventually in trading. It only takes time and it takes the right effort. Remember, I use the word right effort, not just effort, right effort. Do you understand that? And also have at the back of your mind, losses are part of the game. You just have to be very careful with everything you are doing. Do you get that? And always do well to come into my DM. I'll definitely attend to you. I'm always active online. Thank you so much. Have a wonderful day and wishing you guys a proper and happy trading. Peace out, guys. Bye.
Bye.